And what that really means in a nutshell, so a positive expectancy is that every time we risk a dollar, we're at least making more than a dollar that we risk. So we've got to have an outcome where, regardless of our win rate, we are actually making more money than we risk in the market based on our trading performance. So it's all well and good to have a 70% win rate, but if we're losing more than we win, we're losing twice as much as we win, then we're going to have what we call a negative expectancy. So we need to make sure that we're actually making money when we trade, particularly when we factor in things like cost of trade and we factor in slippage. So slippage is where, as we know, we don't get filled at the right level. We get filled at a worse price than we're looking to get in on the market. So, and again, a good reward to risk is all about making sure that that when we go into the market, we're looking for making, say, $2 or $3 to $2 or $3 to $1, so, or more. So we just need to make sure that when we're in the market, we've actually got a good reward to risk. So that's what a good trading system has. Now that's not just the picture, is it? We know that the system is only really a small part of what we need as traders to be successful. So there's also one critical thing that is missing from this little cycle. And what would that be? What would be one of the big things that we're going to have to make this all work well? What's one of the things that we're going to need to put to this to make it run well and be successful as taking it from actually a money management plan and a system into the market? We're going to need. Anybody want to have a go at that one? Yeah, so it's going to be you. It's going to basically be you. You need to be, the answer to that one is you need to be at the top of your game. So you need to develop all the attributes: discipline, focus, concentration. You have to have a very good mental attitude. So these things are going to be critical to you being successful. So it's about, really, this is where we start kind of putting some of the pieces together, and we need to do that. So we're going to work on doing that over the next few weeks. We're going to start that. So let's move on to our next slide here, which will skip the rate of decrease because that's a little bit. Actually, we'll talk about this. So just the science of trading. So remembering that trading or money management is can really be defined as the science of determining how much risk on how much to risk on an individual trade. So proper money management is the basis for mathematical calculations. So there are three concepts when we're trading. We're trading basically to determine when to get in or where to get in, where to get out, and how much we want to risk. So with our money management formula, we're going to develop up a strategy and a formula, and part of that will be the rate of decrease. We'll also have what we call a rate of increase as well. But money management is really focuses on the science of determining how much we're going to risk on an individual trade. So it's really going to be a model that we have rather than just a concept. So a lot of people, when we first start this course, they think of money management as being something they're going to learn. It's a concept in the market. But what we're going to actually do is we're going to develop something that you're going to use every single day when you trade. So it's not going to be just some information that we pick up. It's actually going to be something that we use as a tool to trade. So the things that we want to focus in on are the three concepts of trading. We're going to look at where we get in and how we get in, how much risk we're going to take there. We're going to look at where to get out, how to capitalise on the profit we're taking from the market, and how much we're going to risk on a particular trade. So do we risk one contract, two contract? At what point do we actually increase our risk when we're trading, and at what point do we actually start to leverage up our account? Because one of the big things with trading is that a lot of you may be familiar with the forex market. There's substantial leverage in the forex market. You can control a substantial amount of money with a very small deposit, but that's a double-edged sword. So we need to be very good at understanding how we control and manage risk, as well as leverage. So one of the most important principles to money management is that no matter how good your system is, or no matter how good your strategy is, no mathematical money management formula can turn a losing expectation into a winning expectation. So what that basically means is that if we are trading with a negative expectation, it means that we have our reward to risk is skewed against us. So instead of having, say, a 2-to-1, 3-to-1, 4-to-1 reward to risk when we're trading in the market, if that's the other way around, where we're trying to make $1 and we're risking $2 and $3, and you might think, well, that doesn't seem right. Like it doesn't seem like you would be wanting to go for $100 and risk 200. But a lot of strategies out there in the marketplace actually work on the premise that they try to go for a higher win rate, and to sacrifice or to achieve that higher win rate, they actually try to just take a small amount of money. So it might be, say, $50, and they'll open their risk right up to take, say, $200 to $300. So they might win, 8 times out of 10, but they're only winning $50 every time. Now, what happens is, as we all know, every system, no matter how well it's designed and performs, always goes through a losing run or a losing cycle, or has losing trades, where your edge in the market, or your pattern, or whatever it is that you've designed, or whatever the entry point is, starts to lose its edge. And it might only be for a short period of time, but when that does happen, those losses that we factored in at only 20% of our overall win to loss ratio, if they go down to 50-50 or worse, then we've got a serious problem with our trading strategy, because we're risking 2-3 times as much as we're actually making, and it's very hard to come back from that. So once you start a losing cycle and you've got a negative expectancy, it means you're losing more than you're potentially winning, then it's very difficult to make those gains back up. So what we as traders need to do is remember that when we're trading, we always want to have that positive expectation, that ability to be able to make more money than we're risking in the market. And you'll see as we go through the money management program that our win rate, and we talk about this a lot in our room, our win rate becomes less important, because we are going to give ourselves a substantial edge in the market that allows us to take 2, 3, 4, 5 times as much profit out of the market than we ever risk. And our goal when we start a trade, remember that getting into the trades, the trade is around about 10 to 15%. So that's what we want to kind of give ourselves, as far as that's what the importance of getting into the trade is, about 10 or 15% of our overall system. So one of the keys for us will be managing the trade and taking as much profit out of the trade, and not cutting our trades too short. So one of the things that happens to a lot of traders, or some traders, is when they go through a losing run. What do you think happens to people when, say for example, they have a system that runs it, it offers $100 for every winner and has $100 for every loser? What do you think happens to traders who experience a bit of a losing run? what's one of the first things that happen? Say, for example, we've got some new traders, they have 3 or 4 losers in a row. What is one of the first things that they typically do when they take their next trade, even if it's the next day or the next week? What do they generally do to protect their risk in the market if they've had a series of losing trades? Anybody want to have a go at that one? Yeah, getting some good answers here. Yeah, so all of those things happen, don't they? They they either now this is an interesting one because this happens at the casinos. When at the casino, it's the double up effect, or you double down as you're losing. Basically, you as you take a losing trade, you're trying to recover that initial investment. So this happens a lot on the roulette table. So one of the strategies is to double your position size. Double your position size. So if you have, so the idea there is that eventually the you're going to get a black. Say you're betting against red every time. You're eventually going to get a a, a red setup. If you're getting red, 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 you're eventually going to get a black setup. So what roulette players do, and you'll see it at the casinos, is they try to double up their bet. But at what point? At what point can you potentially, hold that position? Because you're trying to get back to break even. You're doubling up your bet size, and the bet size can get exceptionally large. So what we want to avoid is we want to avoid any type of deviation from our money management plan. So, hey Adrian, how are you? We've just covered a couple of small things. I'm recording it, so you definitely won't miss anything as far as the presentation. So I'll be uploading that to the money management module. But just recapping there, I was just mentioning that what happens typically when we have 3 or 4 losers in a row when we're trading, the first thing we do, the first thing most of us will do, will think, okay, that we don't generally look at whether we're doing the right thing, because systems will invariably go through losing runs. That's going to happen. It will happen to you. And this is why when we talk about trading and trading your system, you've got to make sure that you prepare yourself when you start trading for the worst possible run. And this is why we're going to go through the data. We go through the data and we say, right, well, from the 5th to the 12th of April, this thing had 7 losing trades in a row. All right, so I know for the full year it made, say, $30,000 or $40,000. I'm happy with the win rate. I'm happy with the positive expectancy. But I know at its worst, when it traded, it had 7 losers in a row. You need to mentally prepare yourself for that to happen to you. Because if you don't do that when you start trading, because what we generally do is we always think about if we see a system that's performed well, we always look at the positive side of the system. We never really investigate or prepare ourselves for what potentially could go wrong. But that's where we're going to change. We're going to look at contingencies. We're going to look at the worst losing run, the largest drawdown, and that's what we're going to focus in on, because that's what we're going to prepare ourselves for. So we are, when we trade in the market, mentally prepared to take a drawdown, and also we have the skills to be able to trade through that. So what generally happens when we go through a losing run is a lot of traders either adjust their trade plan, so they'll tweak their trade plan because they think it's broken. They'll change the time frame. They will add an indicator. We spoke, Tim and Mel, today about the 300 odd indicators on TradeStation. Who's done that before? I know I have. Like, I've definitely done that before when I first started. I've definitely made that mistake. Has anybody else added an indicator or tweaked their trade plan when they've gone through a losing run? I think most people uh, definitely definitely do that. So I mean, if you think about what you're going to do over the next 6 to 8 weeks, you're going to do a lot